Test 1, 2, 3. Everybody being here bright and
Recording in progress.
Particularly with the recent time change. We are going to start with the things that do not require a quorum because we're about 15 minutes away from establishing a quorum. So we're not going to call the roll or anything like that. We are going to call the meeting to order. And I believe we do have to read the procedure for teleconferencing the meeting under AB 2449.
Yes, so I'll do a roll call to confirm attendance. Mr. Gatto?
I'm here.
Miss Me?
Here.
Miss Langton?
Here.
Okay, Mr. Loon, nobody else is here. Okay, so Miss Me is participating by teleconference just for cause contagious illness. Miss Me, can you please confirm if there's any individuals 18 years or older present in your location?
No, I'm the only person at home.
Okay, thank you, Miss Me. Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, and we have the StepStone team presenting today.
Welcome, everybody. So we're going to skip item 3 for the moment. We're going to go to item 4, which is public comment. Do we have any members of the public who have filled in cards?
We don't.
No. All right. So we're going to go to item 5, which is the report. Welcome everybody from StepStone. Thank you very much for being here.
Good morning, Mr. Chair and members of the committee. Today we have scheduled a educational session on private equity with the StepStone Group, the board's private equity consultant. Natalie Walker and Jose Fernandez will be here, both partners at StepStone, to provide the presentation. They'll touch on such topics as asset class characteristics, risk considerations, and performance assessment, among some other things. But please stop them, ask questions. This is an educational session, so I want people to get as much out of it as they can in the hour that we have with the committee. So I will now turn it over to Natalie and Jose to take you through the presentation.
Great. Thank you, Chris, and members of the board. Thanks for having us here today. As Chris said, we are your private equity consultant. Also, our colleagues consult on the real estate portfolio as well. So pleasure to be here. Jose and I have enjoyed working with LACERA and LACERA's staff, and wanted to just take a few minutes this morning to talk about the private equity asset class, orient both existing as well as new members with the asset class. And as Chris said, talk about some of the key characteristics that might be subject for questions as you read through the diligence materials that are put forth on a monthly basis for investment decisions and or investments that have been made on behalf of LACERA. So if we dive in, we're going to start, let's see, on page. Is yours working?
There you go.
No?
Yep.
There we go. Oh, now it's going too fast. Okay. Great. We'll start on page 4. Really just to set the context for what is private equity in its simplest form. So private equity, in simple terms, is really broadly defined as investments in public or non-public companies that are privately negotiated transactions. And that typically results in the private ownership of the business. So typically we think of private equity as investing in private companies. That is generally the case. Private equity can also entail taking public companies private. So hence why non-public positions may also be involved. Typically you pursue private equity either directly in owning the investments or companies directly, and or through investing in private equity fund managers that will essentially raise a private equity fund to invest in a number of companies, thereby kind of increasing diversification and providing institutional investors with access to the asset class. We'll talk today a little bit about the investment stages across private equity, ranging from venture capital and growth equity to traditional buyouts or leveraged buyouts, LBOs, as they're labeled. And we'll also talk about how to gain exposure to the asset class, as well as investment returns, measuring those investment returns. So what are the performance metrics that we track as StepStone and your staff that we present forward to review investment managers and private market investments. So in the right-hand side, you'll see a few characteristics, really kind of a glossary of terms that you'll hear often associated with private equity. Illiquidity is a key aspect of the asset class, typically locked up for a longer duration. Investments in private equity are not readily tradable like they are on a public market exchange. And so you typically want to be compensated for that illiquidity, which we call an illiquidity premium. Also, essential or key to the asset class is the fact that investments, because they're illiquid, typically are held for a longer term horizon. If that's a private company or a direct investment, that's typically 3 to 7 years. If it's investing through a fund, which is a collection of investment companies, private investment companies, typically you would have kind of a 10-year investment horizon. So think of the lifespan of an investment, whether it's a company or through a fund, as kind of 3 to 15 plus years. LACERA specifically has been investing in the asset class since the 80s. So again, has made a long-term commitment to private equity. The cash flow dynamic is important here, and we'll dive into this in a couple of slides, in that you typically experience what we call a J curve, or negative performance in the early years. And that's really the result of investing in a blind pool, the capital going out in the early years. So think kind of years 3 through 5, and coming back to institutional investors in the outer years. So generating a positive return in the outer years. Costs are high. This is typically associated with the active management strategy. So the costs really are indicative of the management fees and the performance fees, which we call carried interest. They're paid to private equity fund managers to compensate them for adding value to their investments and managing those investments through the duration of their lives. And then structure, importantly, typically in the institutional sense, you're investing in private equity funds. So those tend to be close-end funds. What I mean by close-end is it's not easy to get out of them. So you really have to wait for the investments to be exited. Now, recently, there's been, over the past kind of 10 to 15 years, more what we call secondary investment activity. Still highly illiquid, but does provide institutional investors the opportunity to trade interest either in a specific company and or interest in a specific fund. Okay. Oh. Little sensitive. Okay. Great. So I mentioned the private equity spectrum, which we call subsectors here at StepStone, but really what we mean by that is investment stages. So we invest across the investment spectrum, starting from seed and early stage venture capital, which is really concept stage investments in pre-revenue companies, to late stage venture capital, which is still less proven business models, typically higher growth companies, but not yet profitable. To growth equity, where you're typically still kind of higher growth, not as high as maybe late stage venture, typically break even or cash flow positive, but really still kind of in high growth mode, to traditional buyouts, which you'll hear often the term LBO or leveraged buyout. which means you're applying leverage to make an investment in a private equity company. And typically buyout investments are more proven. And those companies have been around for a lot longer. So proven business model, typically lower growth, less than 15%, although there are exceptions. And almost always cash flow positive unless it's a distressed buyout transaction.
Natalie, you'll forgive me for interrupting, and
Sure. Yeah, please do.
Might get to this later in the presentation, and this is an unfair question, but do you know off the top of your head or ballpark what percentage of LACERA's investments within the private equity spectrum are in seed versus late stage VC versus growth versus buyout?
Yeah, so I think the mix shift for venture and growth equity versus buyout is around, I think, Chris, what, 20 to 30% venture and growth equity and 70 to 80% buyout.
Gotcha. So the first two stages are teeny tiny. Got it.
That's right.
Okay. Thank you.
Trustee Gatto, just to provide context, we have a little bit over $1 billion in exposure to early stage VC. Overall, the portfolio is approximately 28% VC and growth, and we have about another $1 billion in the later stage growth aspect. And so everything in between is called balanced.
Thank you. That was very precise.
Yeah.
Off the top of his head, he just walks up and does it. That's amazing. Thank you.
Thanks, Didier. Now, kind of getting to why you would add each of these stages to your investment portfolio. You can see, you heard that LACERA has access to each. Typically, return target or return expectations and volatility differ by each stage. So at the highest return, highest volatility, you have seed and early stage venture capital. So getting into investments early and taking on venture or early stage, early concept risk, you would want to be compensated for taking that risk, and so would expect to generate a higher return. Seed and early stage venture, as well as late stage venture funds, tend to be highly diversified because they have such high loss ratios to diversify some of that risk away. But you would expect, just like you would expect to get compensated for the risk in a direct transaction, you would want to be compensated through higher returns in a VC and or growth equity fund investment. Buyout, on the other hand, lower volatility, typically lower risk, targeting kind of 2 to 3 times your money with less than 20% volatility. Over the last kind of 10 years, buyout funds have been closer to kind of 10% loss ratio, and that can kind of ebb and flow year to year. And then control. So importantly, what level of influence does the private equity firm or asset owner have over making decisions and adding value to the portfolio companies? Typically with seed, early stage venture, late stage venture, and growth equity, you're making minority investments. So the owner and or management of the portfolio company typically have control, whereas in a buyout transaction, you have the ability to effectuate more control and control kind of the majority of the equity ownership. Any questions on just kind of the stages of investment before moving on?
No, but I ask you to pause real quick so that we can establish a quorum.
Great.
Thank you, Madam Secretary. I'm here. Establish quorum. We can do them now. Okay, we're going to pause real quick and go back to item 3, which is the approval of the minutes of the Equity Committee from November 13, 2024. All members have had a moment to review the minutes. All right, we're going to proceed under unanimous consent. Is there any objection to proceeding under unanimous consent? Seeing and hearing none, the minutes stand approved. Okay, please continue.
Great, thanks. So how do you access private equity investments? Historically, it's been really kind of, the opportunity has resided with institutional investors like LACERA. And the ways in which to access investments or strategies, as we call it, really kind of fall into 3 or 4 buckets. So primary investments refer to fund investments. Those are commingled, closed-end funds, typically committing to a blind pool of capital. And those private equity funds are really tasked with managing your investment dollars and making new investments in private equity companies. The second is secondary investments, as I referenced briefly. Over the past kind of 10 to 15 years, there's been a growing interest in just a secondary market for private equity. And really what that means is an ability to trade and or buy or exit investments either in direct companies or in private equity funds. And that really allows institutional investors to rebalance portfolio allocations. So you can kind of toggle allocation to the asset class up or down through the secondary market. You can partner with GPs in the investment of assets and what's become known as continuation vehicles. You can seek partial liquidity, so you can actually sell a slice of your interest in a private equity fund or company. It allows private equity funds to effectuate generational transitions and then other additional reasons to access the secondary market. And then the last is co-investments or direct investments. So what we mean by co-investment is an investment in a private equity company alongside a private equity fund sponsor or manager. And then the last that's actually not on this page would be a direct private market investment into a company, independent of a financial sponsor, where you're really kind of wearing the investment manager hat. That's less frequent amongst the institutional community, and really you find most investments or institutional investors pursuing the 3 strategies here laid out on the page. So then investment cycle of all 3 strategies is important to understand, particularly in that there is a J curve associated with investing in the asset class. So in the left-hand side, you see the cash flow profile of a primary buyout fund, where the investment goes out over the first 1 to 6 years. So what that means is really you're getting capital called to make investments in private equity-backed companies as part of a portfolio approach. You can see in the outer years, really starting in years 3, but more meaningful distributions coming back to the investor in years 6, 7, 8, and 9. And that's really as those general partners look to exit companies, either through partial or full sales of their private equity portfolios. And so you see here the capital calls, the distributions, and cumulative cash flows of a primary fund on the left. On the right, we've compared primaries in the green to the other 2 strategies, private equity secondaries and private equity co-investments. The main difference here is that typically co-investments and secondaries are invested faster, which means when the capital is put out to work more quickly, it comes back typically to institutional investors more quickly, so shortening the J curve, and that can be meaningful in helping improve early performance and interim performance for a total portfolio. So how do we assess performance? There's really two key measures that institutional investors refer to. Internal rate of return and cash on cash multiple. Cash on cash multiple is exactly as it sounds. It's the ratio of money returned to the money invested. Importantly, though, that does not take into consideration the time value of money or your money being managed for a period of time, typically 10 plus years by a private equity fund manager, whereas the internal rate of return does take the timing of cash flows into consideration. So it's actually a calculation based on the timing of positive and negative cash flows and a net present value. You can see in the bottom, we tried to illustrate how it's important to view both IRR and TVM and not one or the other independently. In investment A or example A, well, I guess I should say in both examples, you're investing $100 million. In the first example, investment A, the money goes out over the first 2 years and comes back quicker, leading to a higher IRR. That being said, you're only getting 1.5 times your money versus the second example where it's pretty evenly called over the first 2 years, comes back over a longer term horizon and more meaningful in the outer years, leads to a lower IRR, but a higher ROI or 2x your money. So again, just wanted to place a finer point on the fact that it's important to view or assess performance using both internal rate of return and cash on cash multiple. We talked a little bit about the J curve. Here you can see the typical private markets investment cycle through performance, both IRR and multiple of capital. So the green line, net IRR, the top line on the left-hand side, gross IRR. You can see that the J curve is steeper when incorporating management fees, but ultimately evens out kind of over time. On the right-hand side, you can see kind of the same example or the J curve associated with net multiple of invested capital, where you're starting with kind of 1x or slightly below X and growing that over time as distributions come back and value is created within the portfolio.
Right, so I'll take over from here. Thanks, Natalie, and good morning, everyone. Thank you for having us again. It's really, as Natalie mentioned at the beginning, it's been a great pleasure and a privilege for us to work with LACERA on private equity investments, and then more recently, real estate as well. So on this page 10, we dive into what's the difference between private investments and public equity investments. And here are just some of the points, right? This is a large topic we can probably discuss for a very long time, but just some of the key points. When you're doing due diligence on an investment, a private equity manager has access to proprietary information. They have access to the management of the company that they're looking to invest in, very direct access. That's typically not possible in the public equity markets. So there is access to public filings. Theoretically, everyone has the same access to the same documents and no more. But in private markets, a great manager would have a proprietary angle in terms of how they can do their diligence and how they can get information that may not be readily available to everybody else. When you look at the capital structure of the companies they're looking to invest in, a private equity manager can really optimize for the particular situation that the company is in. They can be creative and they can use a lot of different structures. In public equity markets, they're subject to the constraints of the public markets and what is available to those companies at that time, given the public market constraints. So there are typically more freedom to construct a capital structure that works for the particular company, given its growth rate, its need for investment, and what their plans are for the future. So that's another important feature. And Natalie mentioned, if you're looking at buyouts, those are control investments where the buyout manager has full control of the board and can really be an activist investor and shape how that company is managed and how they do capital deployment and everything related to what the company does and how it does it. As a public equity investor, of course, you usually have much less active investment influence. So you get proxy voting on matters, but usually it's a very disparate shareholder base, and there's limited ability to influence the management to do specific actions. That just leads to what is the value add capability of a private equity manager, because they control the board, they control the investment, they can do certain actions, corporate actions, including replacing management, which is an important tool that's not usually available in the public space. The time horizon Natalie touched on, right, is clearly different on the public equity market. You can get in or get out any day that the market's open, subject to certain volume practical restrictions. But typically you can get in, get out of a company very easily. And that's not true with private markets. You have the holding periods that Natalie was mentioning that can be anywhere from 3 to 15 plus years. Although the secondary market has allowed for more liquidity than used to be the case 10, 15 years ago in the private markets. There are large dedicated pools of capital to buying interest in the secondary market. So that does allow some level of liquidity. You're not 100% locked up, but usually if you are, as an asset owner, trying to trade in the secondary market or sell part of your portfolio, often you have to accept a discount to your net asset value. And that may be appropriate in certain circumstances, because you may expect better returns in the future from the capital that you get from selling those interests. And as you reinvest it, you may expect better returns than if you had stayed in the portfolio that you have. Or also you just might be rebalancing and getting away from some areas that may have been attractive when you invested but are not attractive anymore. So there are reasons why you might accept a discount to net asset value in the secondary market. And it is good to know that possibility is there, because there are large pools of capital available to transact. And finally, the exit options, as a private equity, companies can be exited in a number of ways. IPOs are a very traditional way for a large company, as it has grown and matured, to go into the public market. That does have some downsides as well, in terms of usually when a private equity manager takes a company public, they're not able to monetize the investment at the time of the IPO. They get the increase in value that usually comes from listing in the public market, but then they have to sell those shares over a period of time. They tend to be locked up, meaning they cannot sell for at least 6 months after the IPO. And then usually because of volume restrictions, they may need to sort of dribble out the position over a period of time. So that's why M&A, private M&A, basically selling to another company or selling to another financial sponsor, tends to be a popular option, because usually what happens there is you get 100% of the value of that company in cash, which then gets quickly distributed to the investors in that fund. So that has that advantage. There's also the possibility to take on additional debt and do a dividend recapitalization, meaning either because they take on additional debt or because the company is generating a lot of cash flow and doesn't need that cash flow to reinvest in the business. You can take that and make a dividend distribution to the partners who are still holding on to the existing equity. So that's one way to have an interim distribution of capital while keeping your equity position. And then I talked about secondary transactions. Of course, on the public market, you just sell at the market price when you can sell. So next page goes a little bit to the issue. Well, if we have to accept illiquidity and it's not that easy to sell, why are we investing in these private markets? And in addition to the potential for returns, which is the main reason you invest in private markets, because you can, the idea is you will hopefully outperform the public markets, but it's a critical diversifier for a portfolio. What this shows you is over the past 40 years, the public markets have less companies today than they did 20 years ago. And that is illustrated by the fact here that 93% of companies with more than $50 million of revenue, so these are significant companies, 93% of them are actually private. Only 7% of those companies are listed in public markets. So if you're going to have exposure to the total market of economic activity, you really need to have some exposure to the private markets, or you're missing out on that huge part of the market that is not traded publicly. Also, you get the advantage of enjoying the increase in value while that company is private from the time, in the case of a seed venture investment, from the time the company started to the time the company goes public. If you're not participating in the private markets, you don't get to enjoy that increase in value. And that has also significantly shifted over the last 20 years. Companies in the early 2000s, late 90s, early 2000s, used to go public even if they had a small amount of revenues or even negative cash flows. Public markets are not really available to companies with negative cash flows for the most part. There's some exceptions in biotech and others, but most companies need to be mature, need to have a track record of performance, and need to be large. It used to be companies could go public with a valuation of $300 million. Today, $1 billion is bare minimum for a company to go public. So that keeps...
Just to clarify, when you talk about how 20 years prior there were less public companies, you're not talking a raw number, right? You're talking the market cap, right? There's a small.
No, actually the raw number.
Ratio.
Yeah,
raw number.
Yeah, there are less number of public companies today than there were 20 years ago.
It feels like there's more.
Yeah,
I mean, it feels like there's a gazillion stock symbols.
I think what you don't see again is a lot of smaller companies that would have been public today because of the regulatory environment. It's very expensive to be public. Smaller companies just are not public today, and there's been consolidation of the industry as well.
Gotcha. Thank you.
So just to give you an example of what I was talking about in terms of capturing the increase in value of these companies while they're private until they go public. Google, which everybody knows, right, went public in 2004, and their valuation at the time was $24 billion, $23 billion, which was a very large IPO. But Google today is worth $2 trillion, right? So public investors have certainly enjoyed a tremendous increase in value from 23 billion to 2 trillion. But if you were not in the private markets, if you had invested in Google when it was private, you could have enjoyed the increase in value from when they started to $23 billion, right? And companies are staying private longer today and not going public until some of them until they're very large companies. So another example everybody might know is SpaceX. SpaceX is currently valued at around $350 billion. is a private company with a lot of private investors in it, a lot of private equity funds, venture capital funds that are invested in it. SpaceX is not expected to go public in the very near future, so there's additional value creation there before they go public. So there's many companies like that where their valuations are $50 billion and above, and they're still private companies. So you want exposure to those companies, you have to be in the private market. So page 12 talks about the importance of portfolio vintage year diversification. I think everyone knows timing the markets is not a good idea, whether that's private markets or public markets. While the return patterns for private equity can be cyclical. You got some years that are up, some years that are down, but it's hard, if not impossible, to predict which years are going to be up and which years are going to be down. And therefore, having a consistent pacing of your investments every year, so you get exposure to those years that are up in a consistent manner, and not, the worst thing that any institutional investor can do, and it has happened in the past, is there was a bad year, so the reaction is, let's not invest as much this year as the past year because it was a bad year, and then that year that you decided to invest less turns out to be a really good year, and you miss out on those returns. So having a consistent pacing structure is really important, and that's part of what LACERA works hard at in terms of understanding what the percentage of the portfolio should be in the private markets, and then having a consistent approach to allocating that capital over the years and not reacting on a short-term basis. The next page here illustrates what I was talking about in terms of cyclicality of returns. You can clearly see this shows you the public market returns. This is 1 year returns for each of these vintage years, starting in the year 2000. Public markets is in the dark color. I don't know if that's blue or purple, but and then the private markets in green, with the difference in returns between the two being that orange diamond that you see there. So this shows you why it is important to be consistently investing in the markets, because we don't know which year is going to look like 2008 and which year is going to look like 2021. And you would not want to have invested a lot of capital in 2008 and no capital in 2021, right? That would not be a good situation. But the key is, if you're diversified, then you can enjoy the returns, which, if you look at this chart, 17 out of those 25 years that I've shown on the page, private equity has outperformed the public markets. So clearly there's been some years of underperformance, but for the majority of the years, the private markets have outperformed. And page 14, just in case I didn't make it clear, it's important to be consistent. One more page to highlight that fact. It's typical that after a recession, again, a lot of investors sort of rethink their strategy and think we just had a recession, we had bad returns, maybe we should stop investing as much as we were before. And what happens is, again, they miss out on some significant returns that come on the rebound, and you have this negative correlation between limited partners making commitments and the vintage year returns. So when the limited partners had made the least amount of commitments, those have tended to be the best returning years. So again, if you have a consistent deployment strategy, then you smooth out that variability a lot. And final page here, some of the risk, right? So clearly there are risks to investing in private markets. We mentioned some of them already, but it's an illiquid asset class. And while I mentioned the secondary markets are much more active today, and there is this possibility to sell, again, there is the usually the reality that you have to accept a discount when you do sell, and that's a barrier. It's a blind pool investment, as Natalie mentioned. When you're doing a primary investment, you're committing to a manager. We do a lot of diligence on that manager to understand what their track record is, what their history is, and why they are well positioned to do well with that capital. But we don't know what companies they're going to invest in when we make the commitment, and that's a risk, because while we put as many safeguards as we can around the manager not straying from the strategy, you don't know exactly what companies they will invest in, and what the environment is, because you're committing the capital for a long period of time. They can invest it over 5 years, and the economic environment may change significantly over those 5 years, and you have no control typically to stop them from investing if circumstances have changed. So it's one of the risks. Manager performance, of course, varies between different managers and different strategies and different funds. So that is, again, part of the diligence work that we do. But as the famous saying goes, past performance is not indicative of future performance. So as much as diligence as we can do on their track record and their history, we just don't know how that manager, who may have been an excellent performer in the past, that performance may not endure in the future. The timing of returns is uncertain, and Natalie talked about the cash flow profile of these strategies. Exits can be difficult at certain periods, and we've had a period like that. We're living a period like that over the last couple of years, and we're still in it, and whether there have not been as many exits as historically there were. And it's very difficult to project when you are going to get that capital back. The manager is in control of the exit and when they exit, but the market also has something to say about that. When the M&A market is not particularly active, when the IPO window is closed, it is difficult to exit, and you may not get your capital as quickly as you expected. There's also a valuation risk, and we had not talked about that today yet. But these investments don't have a mark to market like the public markets. Every day at the end of the day, you can look at your public market portfolio and you know exactly what the value is. You don't get that with private equity. You only get quarterly reporting. It comes at a lag. These quarterly reports are usually not issued until 90 days after the end of the quarter, 60 to 90 days after the end of the quarter. So you have a lag in return in reporting, and there's no industry standard about how that reporting is done, how the valuation of those underlying assets are done. It tends to be subjective. It tends to be under the control of the manager. The manager obviously has an incentive to show good performance, although importantly, the way the fees work, the manager does not get additional fees based on the interim valuations. Their performance fees are only paid when they sell the company, and they get the cash, and they get to keep a certain portion of that cash as a performance fee, carried interest, and the rest goes to the limited partners. So these interim valuations are important, but they don't affect the compensation of the manager. They can affect how much capital they raise, right? So if they are raising capital, we're typically more skeptical of some of these marks, because they have an incentive again to show a good track record so they can keep raising capital. But that is part of the diligence work that LACERA staff does, Stepstone does. So the valuation risk is one that's important to understand as well. And then default remedies, we mentioned it's a long-term commitment. It's locked up. Is not easy to transact if you want to get out of it. So these contracts, if you have a key person event, someone that's really important to the fund leaves, there are provisions in the agreement that deal with those situations. And there's a number of things that could come up. If the fund gets into legal trouble, a portfolio company gets into legal trouble, your remedies may be limited. and your ability to replace that manager may be limited. So those are other considerations that you take that come along with being a long-term investment commitment with a legal agreement that dictates what remedies you have in certain situations. That's really the end of our remarks, but we're happy to take any questions on any of these topics.
All right, let's open it up to the committee for questions. I see Trustee Mee with her hand up. Trustee Mee, the floor is yours.
Thank you, Trustee Gatto. Could you make a comment on today's private equity environment? Because in the past few years, they haven't been seen to do well because of high interest rate, and they haven't returned capital as much in the past few years. Anticipating high interest rate environment continuing in the next few years, so what do you think of this environment?
Yeah, you're absolutely correct to point out that the exit environment, or the managers selling the companies that they currently hold, has slowed down significantly over the last 2 years, and we have seen that across the industry. The distributions from partnerships back to limited partners are below the historical averages over the last 2 years. There's a combination of factors for that. I mean, high interest rate is certainly one of them. Uncertainty about certain economic, the economic environment, and that can be geopolitical risk or across the world. This is not just in the US, right? This is a global industry, so it's affected by anything that happens in Europe, anything that happens in Asia, anything that happens in the US affects the environment. Having said that, the private markets, the fundraising, while it has been more difficult for some of these managers, the amount of capital raised continues to be a very large amount of capital. So there is a lot of liquidity that is available to buy some of these companies once some of these matters are resolved. One of the biggest impediments to liquidity has been sort of a disconnect between what the seller wants in terms of price and what the buyer is willing to pay. So 2 years, frankly, is a long time for that disconnect to narrow to where they can transact. So what that means is typically, the seller has to accept that maybe with the price they had in mind for the company that they were trying to sell is not realistic, to be able to come down in price, and then the buyer to either increase their price a little bit and meet where they can transact. So given that we have been in that period for 2 years, we have been expecting that distributions will start being, having more sales of these underlying assets and more distributions to the limited partners. Again, another factor was the regulatory environment. Under the prior administration, the enforcement of antitrust provisions was very robust. That had definitely an impact on some of the exits. This administration may be less aggressive on enforcement of antitrust regulation, and that could potentially improve the transactions in the market and the distributions back to LPs. So it is, as we mentioned, it is a cyclical industry. We have periods where distributions come down, there's not as much activity, and then periods where activity ramps up. So remains to be seen. There's clearly a lot of uncertainty in the market with respect to what exactly the regulatory environment will be, what the interest rates long-term are going to settle at, and that all weighs on the industry. But there's pent-up demand, certainly, for sales, and there is capital to absorb those transactions. So, it's hard for us to predict whether that's going to be this year or next year, but we certainly expect that to pick up.
Thank you. I'll let Trustee John go first. I have one minor question and come back later.
Fantastic. Mr. Jones, the floor is yours.
I was going to say, Trustee Meese, you can go ahead if you wanted to. Yeah.
Sure. As just looking at the risk on the table here, there's one common things that private equity always do is leverage, right? Especially buyout, we have higher level of leverage also in on the average. So could you comment on that leverage risk?
Yeah. So
how to evaluate that? Yeah.
Yeah. Thank you for the question. So for as Natalie mentioned, some of they may be known as leverage buyout. So yes, leverage is utilized with the in the private equity sector. That's why the companies that they buy tend to be mature companies with cash flow that can service the interest expense of that leverage. The risk is if the company profile changes, whether the market changes or the company doesn't execute on the plan or has any operational issues, and they don't produce the cash flow to be able to service the credit that they have taken on, the debt they taken on, that puts the equity at risk because the debt has to be paid first, and if that debt is not repaid, that the debtor, the lender can take over the company and at worst wipe out the equity entirely. So you could lose 100% of your investment. That's why prudent use of leverage is important, and that again is part of our diligence when we're looking at managers. And the one thing we'll say is clearly before the great financial crisis, 2008, a lot of private equity funds were very aggressive with leverage, and you saw the returns that year, that vintage year, were not great, were not good at all, and that's because leverage was very aggressively used, and companies were lost to the lenders. Use of leverage today is much more prudent than it was at that point of the great financial crisis. So we monitor that in terms of how close to the edge is this company in terms of their use of leverage. So it tends to enhance returns when used appropriately, but the risk is complete loss of capital, and that's something to keep in mind.
Okay. Okay.
Trustee Mee, are your questions completed?
Yes, it was great. Thank you so much, and I appreciate the presentation. There's great use of our consultant. Yeah, thank you.
Fantastic. Trustee Jones.
Thank you, Trustee Gatto. Yeah, just a question, Jose or Natalie. As a board, we're told that our kind of the most important driver of overall portfolio returns, first and foremost, is the strategic asset allocation, and then secondarily, kind of the manager selection that goes into that. Can you kind of talk about a little bit, maybe the evolution of manager selection? Easy money was being made when low interest rate environments, everyone could raise a fund, raise money and do, ideally get, systematic returns. And now that you have a higher interest rate environment and higher uncertainty, how do you pick out the truly skilled managers versus those that were kind of just benefiting from an overall good systemic environment?
Sure. So great question. Starts kind of at the macro level, kind of looking across the investable universe, both from a geographic perspective as well as from an investment stage perspective. So kind of highlighted everything from kind of VC, growth equity to buyout. And so take a macro perspective on where we want to spend our time and our capital. And then I think, to your point, really drill into, after we decided kind of subsector allocations, what the best managers are in each of those sectors, and actually take it even one step further in looking at whether it's healthcare or consumer or technology kind of verticals that we want exposure to based on historical performance. As you mentioned, you can't just look at the historical returns, but you got to think about the strategy in the context of the current market environment and how that strategy will prevail going forward. So we do think there's a level of adaptation that's important in terms of looking and talking to managers about the current strategy and how it works for the current market environment. And then really kind of honing in on the best managers in each of those strategies, subsectors, and geographies to kind of pick the best spots to invest in. But typically really kind of spending our time canvassing the entire investable universe and drilling down into individual segments of the market or themes to pick out the best managers, I think is critical here.
Are there any attributes that you've, over the long arc of the history of StepStone, that as you evolve and you look at management teams and strategies and subsectors, as you suggested, have you come to kind of an absolute kind of key, distinction as you look across those? And I kind of ask this question only because I know we have the big performance book thing during the general meeting where we'll be having a chance to walk through, and I always like to focus on the manager scorecard kind of component of it. But can you just kind of speak a little bit, just for the board's benefit, like across all those things that you mentioned before, have you kind of bubbled up one or two kind of key things that helps differentiate truly?
Yes. Yeah, look, first of all, yeah, we agree a strategic asset allocation is the key. That's going to drive performance. After you said that, then you go and pick the best managers, and hopefully that's what we do. The one thing that comes across immediately is alignment of interest. Alignment of interest, which can be measured in a number of ways, but is not scientific. One way is how much capital is that manager investing out of their own pocket into the strategy side by side with you as an investor. The more they're investing, right? And it's not just, you can't just look at the dollars. It's sort of what is the percentage of the assets they can invest that they're investing side by side with you, right? How important is this to their overall individual net worth when you look at each partner in this firm, right? Or to this firm in particular. Alignment really drives, when you look at correlations, there's a lot of factors and not all of them always correlate to good performance. But while some managers that have a high degree of investment in their own funds don't perform, it's very few of them. So we do see that the more capital they invest of their own capital into a strategy, more likely that fund is to perform better. So when you say like what stands out over the last 20 years, is there one thing you can point to that shows like that manager is more likely to have success than not? That I would immediately point to that. And usually what we see is that when a manager has that, everything else falls into place. The team building falls into place. The way they manage not just their own company, but the relationships with their underlying portfolio companies. That alignment just runs throughout the whole organization and actually to their underlying portfolio companies. So that's the one item we would point out.
I appreciate that, Jose. Thank you very much. Thank you, Trustee Gatto.
Okay, are there any questions from the trustees physically present? Seeing none, that concludes this item. Thank you very much for an excellent presentation. We look forward to seeing you again.
Thanks for having us.
All right, we just have a little bit of housekeeping. That is agenda item 6, items for staff review. Don't see any. Item 7, items for future agendas. Trustees, if you want something on a future agenda, speak up. Seeing none. Go to the order. Anybody have anything they wish to say? Thankfully, the answer is no. Just kidding. All right. Then we are free to adjourn. We will be, well, it's already 9 o'clock. So we'll see you back here in a couple minutes.
Like 10 minutes.
Yeah, let's take a 10-minute break. Thank you.
Recording stopped.